Your 2025 return is finished. You have either received a refund or written a check. And now that we have real numbers in front of us, this is the right time to adjust for 2026. Most people wait until the end of the year to think about taxes. By then, your options are limited. In April, we still have the entire year in front of us. Let's walk through what we should be evaluating now while there's still flexibility. Let's start with the area that typically makes the biggest difference, retirement contributions. For 2026, the 401k elective deferral limit is $24,500. If you qualify for catch-up contributions, additional amounts are available. For those between ages 60 and 63, the catch-up amount can be $11,250. If your tax bill felt higher than expected this year, increasing your contributions now, not in December, spreads the benefit over the entire year. It lowers taxable wages as you earn them and avoids a last-minute cash flow strain. After retirement contributions, we look at health savings accounts. If you're eligible for an HSA in 2026, the contribution limit is $4,400 for self-only coverage and $8,750 for family coverage. There's an additional $1,000 catch-up if you are 55 or older. An HSA is still one of the more efficient accounts in the tax code. Contributions are deductible, earnings grow tax-free, qualified medical withdrawals are tax-free. If you qualify, it is worth funding consistently throughout the year rather than waiting. If you participate in a flexible spending account, that is different. Some plans allow a small carryover or a short grace period, but generally these are use it or lose it accounts. The key is tracking it during the year so funds are not forfeited. From there, we move to investments. Tax loss harvesting remains available in 2026. Capital losses can offset capital gains and up to $3,000 of ordinary income each year. If markets pull back at any point during the year, we can evaluate whether realizing losses improves your overall tax position. Just keep in mind the wash sale rule. If you repurchase substantially identical securities within 30 days, the loss is disallowed. So this needs to be done carefully, not automatically. Next, we consider newer provisions that may apply depending on your situation. If you earn overtime pay, the premium portion, the amount above your regular rate, may be deductible, subject to income limits and overall caps. This is not something that adjusts your paycheck automatically. It affects your income tax return. If overtime is part of your compensation, it is helpful to keep track of it during the year. If you finance a qualifying new passenger vehicle, interest paid on that loan may also be deductible, again, subject to income phase-outs and eligibility requirements. The important part is documentation. Keeping year-to-date interest statements avoids scrambling at filing time. For homeowners, the state and local tax deduction cap is no longer $10,000. Under current law, it increased significantly up to $40,000 with indexing adjustments. That change means some taxpayers who previously took the standard deduction may now benefit from itemizing. But this is not something we decide in December. We look at projected income, property taxes, and state taxes during the year and determine whether itemizing makes sense. We also evaluate Roth conversions. A Roth conversion means moving funds from a traditional retirement account into a Roth account and paying tax on the amount converted. The benefit is that future growth can be tax-free. The question is whether your current tax bracket makes that move reasonable. If 2026 income is expected to be lower than usual or lower than what you anticipate in future years, that may create an opportunity. This is less about market timing and more about tax bracket management. Finally, we address withholding and estimated payments. To avoid underpayment penalties, you generally need to pay at least 90% of your current year tax liability or 100% of your prior year liability. If your prior year adjusted gross income exceeded $150,000, that threshold becomes 110% of prior year tax. If this year surprised you, now is the time to adjust withholding or estimated payments so it does not happen again. Your 2025 return gives us information. We use that information to make changes early in 2026. Tax planning is not a year-end event. It is a series of small adjustments made throughout the year. If you would like to review how these items apply to your situation, we can schedule a planning session and run the numbers. The goal is simple: fewer surprises and better control over the result. Click the link in the description to request a tax planning call. We use a short questionnaire to make sure this is a good fit for both sides. Like this video and share this to someone who can take away some key points from this video.